Hey there, welcome to the webinar. I'm Scott Welsh, and I'm pretty excited about our topic for today. But before we get into it, as always, we got to go through our disclaimer. Please don't risk any money that you cannot afford to lose, and past performance does not guarantee future results, right? You know all that, but please remember that as we get into our discussion. All right, let's get into it. I don't know about you, but I am absolutely fascinated by old trading strategies that were wildly successful, especially if they happened a long time ago. It makes me wonder, were they lucky? Is it outdated? Or are these fantastic strategies applicable to us today? Can we take something that worked a long time ago and make it make money for us today, right? If it's been around a while, surely there's something to it. Well, I like to look at old strategies and find out. And that's exactly what we're going to do today. So, what strategy are we looking at that was successful in the past? Well, it's the mutual fund technique, but specifically on low priced stocks. Now, I understand that's a terrible title. I didn't know what else to call it, but it's still fascinating. And here's what I'm talking about. Maybe you've heard of mutual funds, or maybe you've seen Templeton commercials on your TV. Well, if you have, this all went back to one person, and that was Sir John Templeton. He is considered, by people who consider these things, one of the greatest investors of all time. And he's the father of today's modern diversified mutual funds. If you own a mutual fund, or someone you know owned a mutual fund, basically Sir John was the one who brought that idea to us. So, pretty famous, pretty cool. Well, how did he make his money? That's really why we're here. Well, he used a diversified mutual fund technique. Great. What the heck does that mean? I'll tell you. We're going back now for Sir John to 1939, and this is the time of the Great Depression, and that's critical, and we'll talk about that in a little bit. But in 1939, Sir John purchased $100 worth of every stock on the American Stock Exchange that was priced under $1. His idea was, there are good companies out there that have been beaten down for no other reason than the economy beat them down. These stocks are fine and they're a bargain, and I'm going to buy all of them because in this basket of under $1 there are a bunch of stock skyrockets that are going to shoot up and make a lot of money. That was his goal. Find something low priced because A, there's more return, and B, may not be a lot of people even looking at them, right? So you may be able to get kind of a hidden gem or a hidden bargain. Anyway, that's what he was thinking, and that's what he did. But who knows which one is going to be the one that goes up, right? So he did $100 worth. Again, in our money in 2018, that's a lot more money. But he just divided it equally, saying, I'm going to give all of you guys a chance and see what we can do. So that's what he did. He bought 104 companies under $1 and sold, or that, and used $10,400, right? So it's $10,000 worth of stuff, $100 each. How to do? Well, 4 years later, he sold all of his shares. Like, he didn't just sell or creep out. He sold everything for nearly 4 times his original investment, and that is spectacular. And here's a shot of Sir John selling one of those companies now. I see, no, that's actually not. I just like that picture. And I thought, well, it might be Sir John, but probably not. Clearly not. Anyway, so great. Great for Sir John Templeton. What does that mean to us? Does it still work? Well, it might still work, right? If we're going to talk about this, we won't get to any numbers just for a second. Value investing, buying something on sale, has worked for a long time. We all know someone who is a good value investor, a great value investor. Warren Buffett, right? Maybe the greatest value investor. What is Warren Buffett's methodology? It's buying something on sale and holding it and selling it later after it's gone up quite a bit. Now, for that reason, it's worth looking into what Sir John Templeton did, right? We have examples of Warren Buffett doing great. However, Sir John was buying really, really low. Warren Buffett just buys on sale, not necessarily at a super low price. What price it is doesn't matter to Warren Buffett. He just buys it on sale. Sir John said the price itself matters. And that's a crucial distinction because doing what Sir John did is way more volatile. Because if you're buying something low, what's the old saying? It's low for a reason. So Sir John was taking a chance and was doing it with his eyes wide open. He knew what he was doing. But if you buy at a certain price threshold, it is going to be way volatile, especially if that threshold is low. Also, Sir John was doing it in the Depression era. Warren Buffett was definitely made it through some heavy recessions, but it was a completely different time in our country's history and a completely different uh, economic condition, right? So keep that also in the back of your mind. We're going to talk more about that in a second. But nonetheless, I am fascinated by getting 4 times your original investment just by buying low price stocks. So when I was doing a lot of research into old strategies and Sir John in particular, I decided, well, it's time to stop thinking about it and let's start doing it. Let's find out. So I bought an IBD, Investors Business Daily newspaper, and I opened it up and I went to the top ranked low price stock section. And they have that specifically in that newspaper. You have to go through a ton of great information, but they have a section dedicated for basically Sir John Templeton, is what it looks like. They try to give you quality stocks at all sorts of low prices. Now, they aren't all low priced. They go up to, sometimes $10 or even more. But I was interested in what Sir John did. So I went into that top ranked low price section and picked out every single stock, like Sir John, under $1. I figured I was getting quality under $1, right? So, did I get what Sir John got? Get? How'd it go? Let's find out. Here is the portfolio. Now, I recorded this originally in my Yahoo Finance portfolios. I've been tracking various portfolios and various strategies since 2006. And this one is in there on that lengthy list of portfolios that I've been tracking. I figured that's not easy to see. I'm going to put it on a spreadsheet. Hopefully it's easy to see. And here is the exact portfolio. Now, as I mentioned, this was December 5th, 2014. And you can go back and look up these stocks and double check all of this. All of this is researchable to anyone. So check it out if you're interested. Here is ACFN, for example, and ACST and ALN and so forth. Obviously, I went alphabetical, but I stopped at anything that was over $1. Now, that being said, I did sneak one in, okay, just because I wanted to find out. So I didn't quite do exactly what Sir John did. I apologize. If you like, I can take that out. But I did want to throw one. That was, I think, the only one that was, or the next lowest one. But I threw that in there, so I apologize. But as you'll see, I don't really need to apologize. Anyway, to read this chart, that was the price then in 2014. I bought equal amounts of each particular company, just like Sir John. I was trying to get my portfolio right around 10,000. This actually ended up to be a little bit less. And there's the total, right? There they are, all those stocks, equal amounts, and that equals $7,300. This is the price now, as you'll see in the portfolios to come. This is as of April 2018. Okay, so price then, price now, value at start, value now. There you go. And then I added it all up. So there's the original portfolio, and there it is. As you can see, a lot of losers, right? One that even went to zero. Actually, a couple that went to zero, right? As we expected, but that's a little depressing. One other thing is the adjusted price, so you don't get confused. These companies, if you see an adjusted price, went through what's called a reverse stock split. So the price changed if you look it up on your chart. When I got out my IBD newspaper, that was the price, but after the reverse stock split, that's the price. So if you go back to December 2014, this is the price you'll see on the chart, not this. And that's important because if you look at the price then, 47 cents, and look at the price now, 2018 April, $1.15, hey, that's a winner. That's awesome. And I could think I had a winner when it was actually a loser, and I might be considering a strategy that maybe I shouldn't have, right? That's the price. After or taking into account the reverse stock split, that's your price. And you can see that price went down, and that's quite a loss. Got it? So adjusted price means reverse stock split, and that's what you should look up. Otherwise, this price is the accurate one. Okay, you with me? Bottom line is this. Oh, wait, one more thing. AMZG stopped trading in 2015. I'm going to talk about that in detail, but there are some stocks that, for whatever reason, no longer trade. And again, I'll talk about that in a second. So you'll see that also. But bottom line for this is initial was 7,300. The value now, it about cut in half. Surge on Templeton, it doesn't work. This is ridiculously bad. What conclusions can we draw besides it's ridiculously bad? Well, sensibly speaking, we could say that's not enough time. It wasn't quite 4 years from then to now, but it was almost 4 years. I mean, that's really not a good argument, right? I mean, yes, Sir John had 4, but this was about 4, so not really great. It wasn't the right economic conditions, and this is maybe a very valid argument. Remember that Sir John did it in depression. 2014 was not a depression. So maybe this strategy is not something that works well. Low price stocks in good times maybe won't appreciate. Maybe that's something to consider, but maybe not. We'll discuss it again in a few minutes. But maybe under $1 means something completely different now. And that is something that I think we really need to consider. A dollar back then is not the same as a dollar now. Buying at under $1 in 1939 is not the same as buying under $1 now, 2014, 15, 16, whatever. It's different because of inflation, right? So what we're saying is buying an under $1 stock now is basically buying a penny stock back then. And Sir John was not buying a penny stock. He wanted good companies that were just low priced, and he used $1 as his cutoff, kind of an arbitrary one. But $1 doesn't mean the same. So I think it's not apples to apples. If we follow exactly Sir John's methodology, we're actually buying a much lower quality stock. We are buying literally a penny stock. A $1 stock now is buying like a stock that's worth a penny back then. So it's a totally different breed of stock, right? And I think that is a valid argument. So valid, in fact, that I did more research because I didn't think that was a good indicator of what this type of trading can do. Okay, so we're going to get into another portfolio and try to do apples to apples. But just keep in mind, FYI, I collect IBDs. I buy them every year, and I have a huge stash of newspapers that's quite high. It moves with me everywhere I go. If we change houses, the IBDs come with me. Nothing's ever been thrown away. So I have a very, very nice resource. So keep that in mind. I'm getting this information right out of the newspaper as if I've been able to go back in time and open up and do this in current day. So I thought that was A, good for accuracy, and B, if we want to replicate this going forward, it's possible, right? It becomes, as I said, an apples to apples type thing. So keep in mind, I collect them, and this is straight from a real newspaper. So I took out my big stash and I looked at the top one, and it was from 2012. So I thought that's perfect. That's over 4 years. That gives us that encapsulates the amount of time that Sir John did it. I just thought this would be an excellent way to really look at this strategy and see if it's worthwhile. Okay. However, I did make one change. I didn't just choose under $1. I included it, but I went up to $3. Now, it was arbitrary, right? It gave me a nice basket of stocks, right? I didn't want just one or two, but I didn't want, 200 stocks. So raising it to $3, I thought just made sense to me, and it also gave me a nice size portfolio. So you could do $5, $6, $9. You can do whatever you want if you're interested and want to do your own research. But I raised it to $3, and I thought that made sense, and I thought it was a good thing to do. So here we are, straight from the IBD newspaper, top-ranked low-price stocks. I went back to August 22nd, 2012, and this time I got 25 different stocks that all made the under $3 threshold. Okay? Now, as you can see, $1, $2, right? There's some that are under a dollar, so it didn't exclude all of them, but it got, well, it got a nice wide range of prices here, but also, look, over a dollar. So my hypothesis, I feel like, was kind of right. There was only one that I found in 2012 that was under a dollar. Now that one did do well. It made a great return. However, you can see that we have a much wider range. So there's your price then, 2012. There's your price now. Again, these are all, you can all research these. These are readily available to anyone with a computer. You can see that I divided all 25 equally into $400 segments, and I bought the number of shares that would fit into $400. Got that. Added up to 10,000. We have some reverse stock splits. So for Newt, for example, you want to go back and look it up. It's $9.85 rather than $1.97. No problem. The price now is accurate, so that's no problem. And look at what we have here. We've got a bunch of big winners, some that have doubled, lot that have doubled, right? And we have a value now of a $10,000 portfolio has gone up to $24,600 again as of April 2018. That's pretty cool, right? Now, we do see some stocks in yellow. These are stocks, as I mentioned earlier, that no longer trade. If you look up CRWN, you will not find it. Why? Well, it stopped trading on 4/29/2016. Well, that's weird. Why did it stop trading? Because it was bought out. Anytime any of these companies stop trading, it's because they were acquired or merged with another company, and thus they became a different entity altogether, and thus they have no more stock trading for that particular company. So CRWN started at $1.72. It was bought out by Hallmark greeting cards, bought them out, and at that price, it was about $5. So we had seen a nice rise in price, but we would have been bought out too at that particular point, and we would have locked in our gain. Well, which no problem, right? $400 had turned into our $400 investment had turned into $1,100, so that was fine with that. But this portfolio amount means that it got no more gains from CRWN. That just stopped. So those gains were no longer available. So they could be replaced, or you just wait for everything to be sold out and then start all over again. So you have YAVY, that was bought out by FNB Group, ZIPR was bought out by Reology Holdings, and so forth. So when the company was bought out, you won't see it on a chart, but everything else you'll see on a chart. Okay, so maybe there's something to this after all. If you're looking at the compounded return as of 4/5/2018, again, April 2018. So present value when we looked at it was 10,000. It increased up to 24.6. It's about 5.5 years from then to now. And that is a compounded annual growth rate of 17.78%. It's pretty nice. I mean, 17%, over 17% is a good number, right? That beats the market over that time period. So if you had bought an index fund in 2012, or you decided to do a high quality, low price portfolio, the low price portfolio won by a handful of percentage points. And keep in mind that we could have replaced the ones that were bought out. So maybe we could have done even better. But not putting that into the equation, 17% per year, bottom line, Sir John was right, it beat the market. Now, obviously, you could say, well, some of those, did great. They were big winners. Well, isn't that the point, right? I mean, that is why anyone would do this. We need and want the big winners, or else the ones that go bankrupt will hurt our portfolio and hurt all of our returns. So yes, there were a lot of winners, but that is to be expected. Clearly, under $3 was a great threshold, right? Under $3 works better. Much higher quality. We're still getting low price stocks. We're still using the Sir John mentality, but we get a higher level of company by raising it to 3. Again, if you'd like to look at 5 or something else, do so. But $3 worked pretty darn well. And as I said, some drop out. We could just go to our IBD and replace them, right? Just replace them and then possibly even boost our returns even more. So, what do you think now? We made it more apples to apples and it looks pretty good. Well, let's do one more because I think something in the back of my mind is, what if we traded during a bad economic environment just like Sir John did? So, what situation do we have in our semi-recent history that was similar to 1939? Oh, I know, 2008. Well, as it turns out, in my stack of IBDs, I've got plenty of ones in 2008. I was buying them like crazy back then because I was fascinated by the chaos. So, this portfolio is from an actual IBD from that time period. I think it's a pretty accurate depiction of what might have happened or what might happen if we do it in a bad environment. Now, also, I just want, a little pat on my back, or I just want a little credit. You had to look up all these companies, obviously, and there are several companies back in 2008 that were in the top-ranked low-price section. I did have to find all the splits. We're talking about, about 10 years now. So, yeah, it was a lot of work, right? But it was worth it because if you don't do the work, we will not have an accurate idea of how well this will do, right? Again, the stock splits can skew the results. The companies being bought out can skew results. So I did all that. It took a while, but this is accurate, right? This is something I wanted to give you and me an accurate display of what might happen if we do such a strategy. Okay, this should mimic real life, and it gives us a chance to look at a bad economic environment. So let's get to it. November 3rd, 2008, right in the middle of it. September was bad, but if I remember, it was still pretty scary in November, right? Okay, November 3rd, 2008. Here is what was listed, again, under $3. Most of these are over $1. As you can see, there was only one that was under, right? Okay. Same thing. There's the price then. Go back and look it up. If you see a highlight, that means that it no longer trades. It was bought out by, in this example, Snack was bought out by UTZ Quality Food. Utz, I don't know how to pronounce that, but it was bought out by UTZ Quality. COMS was bought by HP, Hewlett Packard, and so forth, right? So 1, 2, 3, 4, 5, 6, 7 of these companies from 2008 are no longer around on our charts. They still exist, but in another form. Okay, so they no longer trade as their own entity. So all of those potential gains were knocked out. So that's important to consider. But here we go. There were 18 stocks that met the criteria, divided them all up equally. All that equals 10,000. There was a reverse stock split on ICAD, so 1270 is the price you'll see, and it dropped. That was a bad one, but we expect that. And let's take a look, and we get some nice appreciation, right? Some of these have gone up quite a bit. This is a $2 stock that went to 24. This is $1.80 to $4. That's pretty good. We got a 283 that went to 28. That's pretty good. And so forth. We got some big wins, right? Oh, we got $1.79 went to 14 bucks, right? So it worked kind of as Sir John guessed, right? And again, you can see all these when they stopped and who they're bought out by. There's your adjusted price. Bottom line, $10,000 turned into 37. Well, what does that mean? Well, 10,000, 37,093. It's about 10 years, 9.25. Hit calculate, and you get a compounded annual growth rate of 15%. And that is much better than the market over that same time period from 2008. Obviously, the market was taking a beating during that time. It did recover, but the market has not recovered as fast as these low-price stocks. So, again, it beat the market, and again, it was similar, right? The ones we did when we expanded out to under $3, we got 17% a year. When we expanded out to $3, we got 15% per year. Again, not including those 7 companies that could have gotten us more gains, right? So, conclusions we can draw. Some fell out, but 15% per year is still better than the market, right? In fact, the market was under 10%. It's nearly double, right? Not quite double, but that's pretty darn good. Now, obviously, going from 2008 to 2018 is longer than Sir John held, but it's nice to see that it actually kept working. He sold out, I assume, because he had made so much money, but we could possibly have sold out any time along these lines and made more money. A lot of these gains, remember, I'm getting current day prices. If you go back and look at the charts, some of them were hyperbolic. They went crazy, or parabolic, hyperbolic too, but they went parabolic and went straight up and then came back down to the current price that I put on the portfolios. There are chances in a lot of these stocks, just so you know, that you could have bought out at a much bigger gain or sold out at a much bigger gain than the price that I have right now. But regardless, we went about a decade and compounded. It still worked out pretty well, right? And we could have replaced those ones that disappeared. So, hmm, what's the bottom line? Well, the bottom line is I love old strategies that made a bunch of money in the past. However, this particular old strategy we're talking about today doesn't work exactly as Sir John did it, but that's only because of inflation. Now, we can't follow it exactly. However, we can follow everything else exactly if we just expand it out. I did $3. I think that looks pretty darn good. Again, you could do further research if you're fascinated and again do a different expansion up to $5 or even $10. Maybe we get an even higher quality of stock then. That's up to you, but I'm pretty satisfied with what $3 looks like. Okay? But overall, I think the conclusions we can draw, and correct me if I'm wrong, is that this appears to be a strategy that, if implemented, can beat the market. However, you do have to consider, just like you have to consider the disclaimer at the beginning, that this is a volatile strategy. You're going to get some huge winners, and that's going to cause an emotional rush. And you're also going to have stocks go to zero, and that's also a different sort of emotion. So there are ways to make even more money out of this if you've sold when it went crazy. If you replace losers, there might be potential to do really great things, but you've got to have an aggressive mindset and you've got to be ready for that to do this sort of thing. That being said, maybe, and I'm just throwing this out there as a suggestion, maybe you could have an index fund, boring old index fund, and then take a portion of your money and try some low price stocks, combine them together. That'd be a little bit safer in quotes, but you might be able to boost your returns even more. But all in all, I think Sir John was onto something, and that might be something that you can further investigate. Here's some contact information. I've been a trader since 2004, and I've been researching various things since then. Got a bunch of IBDs and a bunch of information from old strategies on the past. So feel free to email me and ask me about anything or any questions you had on this particular webinar. It was great to be here. I hope it's something that's useful for you, and I hope to see you again real soon. Happy trading. Bye for now.